We're going to widen this conversation right now to include the broader markets, even though it's almost like Tesla has taken over the markets, at least right now. Barbara Reinhard is here, head of asset allocation at Voya Investment Management. I mean, things are just rock and rolling today. It's almost like the coronavirus didn't exist, and Elon Musk is sort of, I don't know, is levitating things.
I can't comment on Tesla. I'm a macro investor, so I have to stick with my knitting.
Okay, so what's happening here?
I would say the following. There's very significant and ample liquidity conditions that have been provided over the course of all of last year. And it's not just the Federal Reserve reducing interest rates. It was the lion's share of global central banks that eased policy.
Right.
Global short rates fell 50 to 75 basis points over the course of the past 12 months. That's a very big elixir for the business cycle conditions, which we started to see unfold in September of last year, which was that the rest of the world, Europe, China, the emerging markets, making a bottom and starting to at least come out of some of the misery that they had been in for the past 18 months.
There was a whole view, even in the past week, of don't buy the dip, right? We had some...
Because Mohamed Al-Arian said central banks cannot solve the coronavirus because they don't have the tools to fix what will be disrupted by the
And clearly somebody's buying the dip.
Well, we should not even be talking about central banks solving the coronavirus. Central banks have a very different goal than solving the world issues.
That was his point, that they can't solve this problem, and this problem from the coronavirus will be so widespread, and they don't have the tools to do it. And so people are conditioned to buy the dip because of liquidity coming in, but liquidity won't help.
Well, you have to decide. There's a central investment decision that you have to make. Do you believe that what has happened over the past couple of weeks can that dislodge the 5 to 6 months reacceleration or bottoming process that you're seeing outside of the rest of the world?
And what's your answer?
The answer is I think you don't have enough data at this point. You had to find out on February 9th if the China factories reopen, because right now you're going to see a demand shock. It's a matter if a demand shock goes through a broader supply shock as well. You just don't have enough information to make that decision.
I agree with that, but the market is basically saying that the coronavirus did its job, which was to provide an excuse to get a frothy market to back off a little bit, put a little fear in the market, shake things out, get bond yields lower. Refinancings are rocking right now. And it's almost as if we don't have it kind of gallop around the world and accelerate from here in terms of viral infections and economic impact, then you basically got your gut check. I'm not saying it's correct, but that's the way the market's treating it.
Step back for just one moment, though. Just even step back from today, step back from the past 6 weeks. Step back from 2018 to mid-year of 2019.
Yes.
In real terms, adjusted for inflation, the equity market went nowhere. It went sideways for the better part of 18 straight months.
As it did to late 2016.
Yeah.
And so when you broke above that, the market re-won the benefit of the doubt for a while. And I think that's where we're psychologically where we are.
Exactly. So the point is that you've had earnings coming in better than expected. You have very attractive liquidity conditions. The rest of the world is feeling a little bit better. You have to wait and see how the coronavirus unfolds. That is enough in terms of our positioning to say you cannot make a decision on something that is just completely unknown at this point.
The market doesn't wait.
Barbara, thank you for helping us through this.